a number of participants that are there, Mr. Pretu Shekhar, so that we can take a call on beginning the session?
Mr. Kumar, we have about 15 participants. I mean, sorry, just hold on. We have 11 participants as of now.
Okay.
Yeah. Total is 15, excluding us is 11.
Okay. Okay. So should we begin or should we wait for another 1 or 2 minutes?
Yeah.
Let's wait for a minute or two.
I just suggest please wait for another 2-3 minutes. So there are only 18 connections so far.
Yeah.
Yes, because we understand that people who click on the link last minute, they have to do the registration formalities as well. So let's just wait for 2-3 minutes and then we can begin the session.
Yeah, fine, no problem. We can do it
Right.
that way.
Right. Yeah, so the numbers are going up. Let's wait for a while.
Ritesh, from your end, I think you will need to, admit them to the room.
Okay. So I have anyway admitted a few, so I'll continue admitting. The
Yes.
only worry is when the PPT starts, then someone has to do it.
Okay.
Will you be able to see it or will Arvind be able to see it?
Since I have passed on the
No.
whole post rights to you, I think only you will be able to do it.
Okay. Okay.
Can we set it to admit all for now, because we have set it to limited people only. I don't think anybody will be joining out of the league.
Okay.
Sir, the system is anyone who is basically in fact having the login rights, he has to be in fact admitted by the host. Then only they can enter into the meet room.
Okay.
Yeah, so that is the process.
In some of the VCs, they have that setting of admitting all
Okay.
after one point of time.
Okay.
So
So we are now up at 23 participants, including PPC and my ForexSci members.
So should we start?
Yeah, sure. Has Mr. Arora also joined in, sir?
23.
Yes, I am there, very much there.
Okay, fine, sir. Fine.
Okay. We'll begin at 3:05. Okay. I'll
Sure.
request all the participants who have joined in to bear with us. Let's wait for 2 minutes and then we'll begin the session.
इसको वहाँ कहाँ से बंद होता है? इसका आपका माइक कहाँ है?
Good afternoon, Mr. Sujay Nandi.
Let me.
I think we can start now. We are about
Okay.
26 of us now.
Yes, let's begin then.
Yeah.
So good afternoon, ladies and gentlemen. I am Praveen Kumar, Secretary with Project Export Promotion Council. And I would like to extend a warm welcome to all the speakers and our industry members and participants on behalf of PEPC. As you all know, we are facing a very challenging situation owing to the COVID pandemic on both professional and personal fronts. And we are hopeful that all of us will come out stronger from this situation. Today's webinar is an effort towards organizing interactions which are project export specific and deal with differentiating attributes of project exports. We hope that with your cooperation, participation, and feedback, we would be adding new topics and higher value to these interactive sessions. Going forward, we would also have similar interactions for policy side of project exports and other aspects that concern project exports, going to it, differentiating attributes from other exports. Now, I would like to call up our working committee member, Shri B.K. Arora, to deliver the welcome address. Let me just give an introduction of Mr. B.K. Arora. Mr. B.K. Arora is an MTech by qualification and has joined AFCONS in 1980. And he's working for the last 45 years with AFCONS. So he's a stalwart in himself. He has executed projects as project manager and as coordinator in varied infrastructure projects, including marine, ports and jetties, highways, bridges and metro, and subsequently taken up business development aspects in India and overseas, including Middle East, Africa, and Latin America. During project executed project involved adaptation of new technology like steel piles in marine environment by diesel hammer, metro construction by precast segments, and erection by launching truss. Also having extensive experience of executing projects funded by international funding agencies like World Bank, ADB, and JICA. And he has had fairly good exposure in contract execution, contract management, and business development to be his core area of interest. As part of business development, commenced companies operations in Middle East, followed business development in Africa with reasonable success and securing projects. So may I now call up upon Mr. Arora to deliver his welcome address, please. Mr. Arora, please.
I think Mr. Arora is mute.
Mr. Arora, can you?
Good afternoon and welcome, distinguished speakers. Shri Priyetu Shekhar, Country Head of MyEye Forex Infratech, FinTech Private Limited, and Shri Ritesh Victor, Co-founder and Country Head, MyEye Forex FinTech Private Limited, Secretary PEPC, Mr. Praveen Kumar, Mr. Jacob, member of PEPC, and delegates attending from industry this webinar. Project, at the cost of repetition, let me just give a little brief of Project Export Council. Project Export Promotion Council of India, PEPC, is an export promotion council set up by Government of India in 1984, originally as Overseas Construction Council of India. PEPC, in line with foreign trade policy of Government of India, not only undertakes the necessary export promotion initiatives, but also provides necessary technical information, guidance, and support to Indian civil and engineering construction, including process engineering contractors and consultants in private or in public, to set up overseas projects in any of the following module of engineering services: civil construction, structural or infrastructure, turnkey, process and engineering consultancy services, project construction items, including project goods, excluding cement and steel. PEPC, in its endeavor to promote project export, provides a platform for the exporters and countries looking for construction services, and also gathers and shares the information to the industry of the project export opportunities. PEPC is also trying to gather and share relevant expertise that will assist the exporters like issue of taxation, foreign exchange, logistic and financing, etc. Indian construction industry contributes about 5% of GDP and employs about 200 construction firms and expected to generate project worth 100 lakh crore or $1.4 trillion over the next 5 years. It is a major employer in the country. Considering the engagement, the industry is mature, vis-a-vis technology deployment and skill availability, and is continuously evolving, including in project export. As per Ministry of Commerce year 2021 and review of the export trade has shown positive results. They are export target of $400 billion set for merchandise in 21-22 is on course to the scale that about 66% is achieved till November end. Merchandise export tops 263 billion during the period April-November 21, jumped more than 51% over the period last year. India-Mauritius signed Comprehensive Economic Cooperation and Partnership Agreement in February. India-UAE CEPA negotiation conclude, while India-Australia CECA interim agreement expected soon. The service sector also contributes significantly to India's overall exports. In year 22 till September 21, as per Reserve Bank of India data, India service export stood at $135.85 billion, registering a 19.6 year-on-year growth and amounting to almost 37% of total export. The growth in export is driven by key segments such as professional management consulting services, freight transport services, audiovisual related services, and telecommunication. On project export, Export-Import Bank of India is targeting to achieve a financing of $7 billion of project export over the next 5 years, with the government announcing fund infusion of 1,650 crores or $219 million in the National Export Insurance Account to boost project export. The opportunity for Indian exporters continues to be significant, given the fact that project exporters have already developed significant competitiveness in several sectors, and financing options provided by Exim Bank are well established. However, a lot is yet to be learned, like how to deal with foreign exchange and inherent risk involved in change in rate of currency vis-a-vis Indian rupee. More so if the project is funded by Indian rupee. This becomes more challenging if the client passes on the risk to the contractor and the terms of contract do not define what rate currency would be exchanged or what source of currency rate to be followed in the bidding time or at the time of execution. With that, I would just end here and would pass it on to Mr. Praveen Kumar to take it up further. And we would like to hear. Thank you very much.
Thank you, sir. Thank you so much for the wonderful welcome address. You gave almost all the details of project exports and current foreign forex performance on export side. Now, I would just like to inform our participants that the original program for session has been reversed, and we would be beginning with the session on evolving trends in forex management, which would be taken up by Mr. Ritesh Victor, who is co-founder and country head of MyForexi Fintech Private Limited. The two sessions would follow seamlessly, so I'll introduce the speakers to you in one go. First, we have Mr. Anand Tandon, who is founder and CEO and would be a speaker on trade finance. And he is a financial markets veteran with over 2 decades of experience in BFSI sector and annulus of Indian Institute of Foreign Trades, IIFT. Anand earlier conducted IndusInd Bank's North Zone operation, handling treasury sales and profit center management. He also worked at ICICI Bank, Mackay Financial and Commercial Services Limited and India Cements Capital and Finance Limited during his previous assignments. His stint with some of the biggest banks and financial institutions was able to expose him to global processes, systems and work methodologies, which would be very helpful for our project exports aspect. He successfully incorporated his prior learnings while conceptualizing and pursuing his entrepreneurial dream by establishment of MyForexI Fintech Private Limited in year 2004. Since then, his company has helped save over $166 million to clients over a transaction turnover of $5.9 billion. Then we would have Mr. Priyathu, who will be speaking on trade finance. He is also a veteran with more than 18 years of collective experience in the forex sphere, working capital management. He has wide range of experience in the field of corporate banking, transaction banking, sales and global treasury solutions. Prior to joining MyForexI, Priyathu was Director, Global Treasury Solutions, Bank of America, where he worked handling integrated working capital management and treasury solutions to business and institutional clients that included services such as treasury management, trade finance, foreign exchange, short-term credit facilities, and global liquidity management. And finally, Mr. Ritesh Victor. He would be taking up the first session on evolving trends in forex management. And he is also a market veteran with more than 20 years of collective experience in forex markets, derivatives, and technical analysis. He has wide-ranging experience as the head of forex and treasury, forex risk management consultant, technical analyst, and as a research manager. Prior to MyForexI, Ritesh was Chief Treasury Officer at Trident Group, a $1 billion plus global conglomerate and one of world's largest terry towel manufacturer exporter. Mr. Victor is the keynote speaker on forex markets and risk management for webinars, seminars conducted by export-import industry associations like FIO, EPCH, TEA, etc. An avid student of forex markets and technical analysis of currency, he has authored numerous technical reports, forex training modules, and risk management presentations. He has also worked extensively on back testing, asset allocation, and optimization of technical indicators. Let me also inform our participants that we'll have these sessions back to back, and then question and answers would be taken up at the end of second session. Can I now call upon Mr. Ritesh Victor to give his presentation on forex, please?
Yeah, thank you. Thank you, sir. Thank you so much for all the kind words, and thank you for this honor and privilege to be here. It's really nice. So I can start now, and as sir said, probably we'll have a question and answer session towards the end. No, so I will just put my presentation on full screen. Praveen sir, you can see the screen now. Is it visible, clear?
Yes, sir. I can see it. Yes,
okay.
sir.
And my voice is audible and clear, loud and clear?
Yes, yes, loud and clear.
Okay, great. Thank you. Thank you. So, good afternoon, everyone. Welcome to this webinar that we are trying to conduct on educating corporates and organizations on forex and trade finance. So we'll have two sessions, first on forex management and the second on trade finance, which Priyathu will take. So please, whenever you have questions, just note it down. We will have a detailed question answer session towards the end of the webinar. Okay, so I'll just present what the brief agenda is for the forex part. Priyathu will take the trade finance part separately. So let's understand what we are going to discuss and ideate upon on foreign exchange. Okay, so what we have tried to capitalize here is certain, the main problem areas that we have faced after interacting with companies in India, exporters and importers in India. And we have tried to find solution to their problems. Okay, so the biggest problem what we have seen is the management of forex rates. So I will talk about how to manage the rates part of it, how to ensure that you are transparent and crisp and clear in terms of getting the best price for your conversions. The second important thing to understand is what are the risk management instruments. Obviously, all of you understand that being exporters and importers, you are exposed to exchange rate risk because of the volatility of the exchange rate. And as I'm sure all of you are aware that the financial markets and the currencies are extremely volatile. So the level of risk is quite high. So what are the commonly available risk management instruments to manage your Forex risk? Third point is one very critical aspect, which I tend to hear from a lot of corporates and exporters in India, that dollar is always gaining, dollar INR is always on an upward trajectory. So why should exporters hedge? So we'll try and give you a small research that we did for the last 20 years data we took out, and I'll explain how that is not entirely true and what is the nitty-gritties given by and proved by the data. Then one particular thing I want to talk about is also for companies like you who have long-term projects. Okay, just like you might have receivables in the long term, you might also have payables in the long term. So what are the industry best practices, or what are the prudent risk management systems whenever you have long-term foreign currency liability? Okay, how do you look at it? How do you manage it? So I'll discuss briefly on that as well. And finally, on optimization of export funding. Okay, that is also an interesting aspect. All of you certainly should know about it, being exporters. So I'll have topics, common topics for exporters, importers both, and some exclusive topics for exporters separately and importers alike. Okay, and towards the end of the second session, we'll have the question answers part. Okay, so let's come to the first concept on the rates part. How do I manage Forex rates? Okay. Now, the biggest challenge in India is about the lack of transparency of Forex rates. And that is primarily because of the level of understanding. Now, understand whenever you are doing a conversion, you need to crisply and clearly understand what is the conversion that I am doing. Because each Forex conversion depends on its transaction type. Okay, if you want to convert today and settle today, then it is called the cash rate. Okay, so there are two steps. First is the fixing of rates, and the second is the settlement of the transaction. So if you're fixing the rate today and settling today, then it is called the cash rate. And cash rate has a kind of a computation. If you are, let's take fixing the rate today and settling tomorrow, then it is a TOM rate. And the most commonly what we use is what we call as the spot rate, where you trade today or fix the rate today, but you settle it 2 working days later. And spot rate is a rate that is commonly available in all platforms, on terminals, public domains. So you need to understand what is the spot rate, what does the settlement mechanism mean. If you want to do any settlement for a period which is beyond the spot, that is called the forward rate. Okay, so these are small, intricate details that all of us needs to understand whenever we are doing a Forex transaction. Because understanding this will let you first know what is exactly my transaction, and then that will also help you in understanding what is the computational methodology for each kind of transaction. In the second slide, I have given you a small table, and this will tell you what variables are used for what kind of transactions. Very critical for each and every one of you, whoever is having export, import, and conversion of foreign exchange. Okay, what we see is the spot rate. Okay, if you want to convert today and credit today, you get the cash rate. So there is a component called cash spot that is reduced or subtracted from the spot rate. And obviously there is something called a bank margin. Bank margin is what the compensation you pay to your bank for all your Forex conversions. So bank margin is subtracted or added depending whether you're an exporter or an importer. Similarly, for TOM, spot, and forward, you have all the variables which are outlined. And the biggest crux is understanding what my transaction type is and what variable will be used for my transaction type so that I can get the right price. Bank margin is very critical because that has to be fixed and that should not be variable. And that should be transparently documented somewhere in some of your books or some of your sanction letters. Okay, very critical, understand the components of Forex rates. The first sentence that I've written in blue, I always feel banks overcharge while converting foreign exchange. This is the common sentence or common feedback that I get from probably almost 100% of the exporters, importers I have met. And why is this? This is primarily because of the lack of availability or lack of transparency of live interbank spot rates. Okay, because all transactions, the basis of the transaction is the spot rate. Okay, and the spot rate is not the real time live spot rate is not available on public domains. It is usually there on online platforms. On you have Thomson Reuters who gives you live spot rates, and then you have Bloomberg terminals. But the worry is these platforms and these terminals are very expensive. So it's very difficult for normal MSMEs or even mid-sized corporates to afford this. So lack of transparency, limited availability is a big challenge in India. Bank margins is something which is the compensation or a cost that you pay to your bank, and that is, mostly it is kept variable and unclear. But since you are the corporate and it is a cost to you, you need to ensure that the margins are clear and they are fixed and they are not variable. So if it is a cost, the cost has to be fixed. You also need to take a few things in understanding that whenever you're converting foreign exchange, understand all the components of the conversion. What is the spot rate? What is the cash spot? What is the margin? The more you get deeper into the components of the transaction, the more clearer you will get and the more transparent your rate mechanism will be. Usually for all conversions, bank just gives you a net rate. So you don't understand what is the spot, what is the margin, what is the cost that you have paid. So getting transparency at its bottom, getting into the root is the biggest step that you can take. Understand one thing, just like you are doing a business, the bankers are your counterparty and they are also doing their business. They also want to make their money. So they would want to maximize their profits. So if they are maximizing their profit, probably companies like us and companies like you, exporters, importers, they are probably losing. And since we are losing money, we need to ensure that we invest time and understanding in terms of getting into the root of the opaqueness and ensuring that all the rates that we get are transparent. Okay, now this is a typical question that a lot of exporters and importers ask me, that whenever I'm doing a forward, what is the forward that I need to do? There are two kinds of forwards. You can put a maturity as a fixed date, or you can put a maturity as a range of days. Predominantly, a lot of companies do a forward, what we call as the window forward, where the maturity is a range of days. They say that I don't know when my receivable or payable is going to come or when am I going to pay. So what happens is I take a range. So I take typically from 1st to 30th of a month. Now the worry with that kind of a forward is if you are an exporter, you get the premium only till the beginning of that period. And you tend to lose the premium for 30 days. So that is nowadays when the premiums are relatively high, that is a good loss of about 23 to 25 paisa for every 30 days. So a very simple mechanism for you is whenever you're doing a forward, do a fixed day forward, take till the last of the maturity date, receive the premium for all exporters, receive the premium till the last date of the maturity. If your money comes in earlier than the maturity, just early utilize the forward. So whenever you are early utilizing the forward, you will just pay back the extra premium that you have received. But I will receive my full premium. If you do a window, you will receive premium only till the beginning of the period. So I tend to lose. So typically window forward you can do when the premium are low. Multiple years back, 2004-5, window forward were very common because that time the entire annual premium was around 60-65 paise. Now 1 year's premium is around 350 paise, which means 3.5 rupees. So it's about 25 paise per month. So if you do a window for 30 days, you tend to lose the entire month's premium. Okay, so that is on the rates part. Again, as I said, any questions, please write it down. We will discuss in detail towards the end. Now, another thing that I want to invest time on is on understanding the various risk management instruments. These are this is the crux of it, because these instruments are actually going to manage your risk or mitigate your risk. There are three categories of instruments. The first category is called forwards and futures. And forwards or futures typically are similar instruments, but they do have inherent differences. both fixes the price for a future delivery. Okay, you sitting today, if you have a receivable or a payable after 3 months or 4 months or 5 months, which is at a future date, you can fix the rate today. Okay, so forwards are typically done with banks in India. So it is called a OTC derivative. It is a over-the-counter contract, and futures are done with exchanges. So you have NSE and BSE, which has very active exchange for currency derivatives. So you can do futures with exchanges. You can do forwards with bank. And both are very similar contracts, very similar products. It manages risk in a very similar way. But there are certain inherent differences in the sense, forwards, as I said, you do with banks, futures you do with exchanges. And forwards are typically customized. You can get any amount for any maturity you want. Futures are standardized contracts. So you typically have month-end deliveries or month-end settlements. NSE is trying to come up with weekly settlements, but that market needs to evolve now. For forwards, if you are very good and confident about rates, in India, forward rates are not transparent, but futures prices are very clear, very transparent. You can just log on to your broking account, online terminal, online broking account, and you get very clearly the rates for futures prices. Okay, so forwards and futures are one category of an instrument where you can fix your exchange rate for a future delivery at today itself. So you are trying to hedge the risk by fixing a rate for a future delivery. And what happens is, whenever market goes up and down, you need not bother because you have already finalized the price at which you will buy or sell foreign currency at the future. So in one way, this is kind of fixing your, reducing the risk or fixing your rate or mitigating the risk. The other, again, futures and forwards are relatively very simple, can be very easily done. Predominantly, majority of the companies, treasuries in India do futures and forwards to manage risk, forex risk. The other slightly complex kind of instruments are what we call as options. Okay, forwards typically what happens is it is a binding contract. So as soon as you do a forward, you are bound by that rate and you are bound by that maturity delivery. You have to either honor the contract or you have to cancel it, and cancellation obviously has a P&L impact. So it is a kind of a binding contract, forwards and futures. What happens in an option is option gives you a right and not an obligation. So you have a choice. You have a choice to use the option and you have a choice of not to use the option. Okay, so that is quite interesting. And to get that choice or to get that right, you have to pay an option premium. So forwards and futures are relatively zero cost instruments. You do not pay specifically anything to get that hedge contract. But whenever you are buying a currency option, you have to pay an upfront premium, which is called an option premium. So there are two kinds of options, a call option, a call and a put. Call option gives you a right to buy the foreign currency. So typically call options are used by importers. Put option gives you a right to sell the foreign currency. So put options will be used by the exporters. And as I said, to buy that call or to buy that put, you have to pay an option premium. And that option premium is calculated using a model. And as I said, it is a completely flexible instrument. So depending upon what the market is on the maturity, you can either exercise the option or you don't exercise the option. So which typically means that once you have paid the option premium upfront, you know what my risk is. Option premium is the maximum that I can lose. So once I pay the premium today, on maturity, I will never have a loss. Okay, I will either gain or I'll be neutral. And for that flexibility, for that option or for that freedom, I pay that upfront option premium. So there is another classification of options in terms of when you can exercise it, something called European options and American option. European option, you can exercise only on the maturity date. American option, you can exercise any date starting from the next working day till the maturity, including the maturity. American option tends to get quite complex, and it's a very difficult decision-making instrument. But fortunately, in India, only European options are allowed. So you can do European options. You can do for 1 year, whatever maturity is there. Exchange is also promoting options, but again, the liquidity is quite less. But your bank, if you have the awareness and the understanding, your bank will certainly give you any option contract that you want to hedge your Forex risk. So the third category of instrument is what we call as currency and interest rate swaps. Okay, again, a different level of concept. It is a swap is just an agreement between two parties to fix a sequence of future cash flows at certain rates. So I have multiple cash flows, either outflows or inflows in the future. So I can swap it. I can fix the rate with my counterparty, with the bank. So there are two kinds of swaps. One is an interest rate swap and the other is a currency swap. In an interest rate swap, you move from what are you swapping? You're swapping your interest rates. Either it's a floating interest rate, so I swap it to a fixed interest rate, or I have a fixed interest rate now and I move to a floating interest rate. So that is what an interest rate swap is. I'll give you a very simple example. Let's take you have a very long-term loan, foreign currency loan. Let's say you have a 5-year dollar loan. So that 5-year dollar loan, you have to make a repayment of principal and you also have to make a repayment of the interest. Now the interest component changes because that is determined by LIBOR, but now it is called short-term funding rate. So the interest component depends upon the interest rate on the dollar, which is short-term funding rate, and that is also volatile. Okay, probably you started when the SOFR or LIBOR was low at 0.5 or 1%, and in the future it goes higher. So you can hedge that risk also. The risk of the interest rate going higher, you can move from a floating interest rate to a fixed interest rate. So you know for sure that your interest component is fixed and it cannot increase beyond that level. So whenever you are envisaging that the interest rate on my foreign currency loan is liable to go higher, then you can swap it. You can swap from a floating interest rate to a fixed interest rate. And you can do the reverse also when you feel that the interest rates are going to go down. Okay, so I have just explained a definition wise what is an interest rate swap, what is a currency swap. Currency is again swapping your one part of currency, your liabilities or assets from one currency to the other for a future period. So you can use both principal and interest, or you can use only principal, or you can use only interest. These are relatively complex structures, and you need to have a detailed level of understanding in terms of pricing and structuring such derivatives. But again, once you are aware, they can be done very easily, and doing it in the right way, it will end up saving a lot of your Forex cost. It will help you mitigate your Forex risk. It will also help you in mitigating your interest rate risk. Okay. Now, this is one of the most interesting things that I want to touch upon, and something which a lot of exporters, probably I would have certainly met in my last 20-21 years of my Forex market experience. I would have met close to about probably 8,000, 9,000 companies in India. And most of the exporters tell me this. Whenever I ask them what is their risk management technique or what is their risk management idea.
I'm attending, but I'm not getting anything.
Sorry, hello. Someone said something?
Mr. Hello.
Yes, I'm here.
Yeah, one of the participants actually was unmute. So that's okay. Just please carry on, please. Okay.
Sorry for the interruption. Sorry to disturb. I'll continue. Okay, so as I was saying, a lot of exporters tell me this, that the dollar INR is always on an upward trajectory, which is true. 3-4 years back, it was 64, 65. Now it is 74, 75. So since the dollar is always on an upward trajectory, why should exporters hedge? And what we tell them is, sir, the dollar is certainly on an upward trajectory, but by not hedging, you are losing something. And what are you losing is what we are going to tell you in the next 2-3 slides. Okay. Now the questions, when someone says this, the question that we ask is, does the rupee always weaken? What has happened in the last 1.5 to 2 months? The rupee has come from 76.30 to levels below 74. So rupee does not weaken always. There are a lot of times when rupee gains as well. Okay, so this continuous upward trajectory is partly true, not always true. What about forward premiums? Because whenever you are hedging forwards, or whenever doing a hedge for a future date, you get something called a forward premium, all exporters. And the big question is, are we looking at the full picture? So I will answer all these questions and the misguided conclusion in the next 2-3 slides. Sorry. What we did was a very simple research, okay? And again, ladies and gentlemen, this is a research with actual facts and figures. This is not a view, okay? This is not a projection. This is not a recommendation. This is facts and figures. Facts of dollar INR of the last 21 years. What I'll tell you a very simple research that we did. What we did was we started from 1st Jan 2000 onwards. Each working day, what we did was we took a simple forward for 3 months, 6 months, and 12 months. So each working day, I am doing 3 forwards, 3 months, 6 months, and 12 months. Now, each day since I am doing, so the forwards are maturing after 3 months on each day. So what I simply do is on the maturity, which means end of 3 months, 6 months, and 12 months, I just compare what is my forward rate with the rate on that day. Okay, so it is a simple comparison between the forward rate and the rate on maturity, or what we call as the spotted maturity. So when you do a forward, you receive the forward premium. All exporters get the forward premium. So it is actually in one way a simple comparison between forward premiums and the natural depreciation of rupee. Okay, so if you are not hedging, you are getting the natural depreciation of rupee. And if you are hedging by taking a forward, you are getting the forward premium. So what I need to compare is, on a long-term basis, what has been the natural depreciation of rupee and what is the long-term average of forward premium. Because if this difference will tell me whether I should hedge or not hedge. Okay, and again, results are startling. You know, it tends to bust a lot of myths. So let me give you the result. The result is here. The average forward premium for the last 21 years has been around 4 to 4.5%. The average forward premium, which means the premium that you receive whenever you're doing a forward, is around 4 to 4.5%. And the natural weakening of the rupee is 2.7%. Natural weakening is 2.7%, and the forward premium is 4.5%. So what my risk is 2.7% and what I get is 4.5%. So there is an average gain of about 1 to 1.5%. What does this mean? This means that if you blindly book forwards every day, whenever you get your export order, if you blindly book your forwards, you get a 4.5% forward premium. And if you don't do anything, the natural rupee weakening will go to 2.7%. So if you do forwards, it is a free gain of anything between 1.3 to 1.75%, depending upon the maturity you choose. And the success ratio, what we call as a success ratio. Success ratio is the number of times or the percentage of times the forward rate is better than the spotted maturity. It is as high as 65%. Okay, so if you do 100 forwards, 65% of the forwards, 65 forwards will be positive and 35 forwards will be negative. And positive, negative net total, you will get 1.3 to 1.75% gain. Okay, so all exporters who are not hedging should certainly see this as an eye-opener and start hedging their receivables. You will get more premium and the possibility that the rupee will weaken or the dollar will gain is there, certainly there, but the long-term average proves something else. The long-term average proves that the forward premiums on a long-term basis have been more than the rupee weakening. Okay, so please take this as a lesson. Start hedging your export receivables. Okay, now let me discuss also on the other side, people on the other side of the fence, the people with long-term liabilities. I've been telling export. Exporters can always hedge. Exporters should be hedging. You get forward premium. So what is for the importer side? What if I have long-term foreign exchange liability? How do I manage that risk? Well, it is a corollary. If it is beneficial for exporters to regularly hedge, get more premium, and the rupee weakening is less, then obviously it is the reverse fence for the importers, which is like you can not hedge immediately, you can look for levels to hedge. Because if I hedge immediately, I pay a higher premium and the risk of currency depreciation is lesser. Okay, so I'll just throw a few ideas. I'll toss it around for you all to introspect and think about it. And I'm sure you will get a lot of ideas of how to frame or how to ideate or at least how to structure a risk management system for long-term liabilities. Okay, as I said, forward premiums have been 4.5%, 4 to 4.5%, and rupee weakening has on a normal scale has only been 2.7%. So what is the methodology that I can use to hedge my long-term liability? One very commonly used methodology, what I've seen in the market is something called the first day forward rate. Okay, now what does a first day forward rate mean? You know, a first day forward simply means as soon as the exposure arises for the long term, get the forward rate if I hedge immediately. I'm not saying hedge immediately. I'm just saying get a rate that what would have been the rate if I would have hedged immediately my long-term liabilities. So it is hedging the liability as soon as it arises. So I'm hedging my risk on the first day itself. Again, as I said, just benchmark it, don't hedge, just benchmark it, get a rate. Now, if once I get a rate, I know that if I would have blindly followed my hedging liability mechanism, I would have got this rate. And we also know that if you are doing this hedge for long term, the normal premium you would have paid is around 4.5%, which is like the current market premium for dollar INR. Sorry, 4.5% forward premium you would have paid. What you can do is after benchmarking, again, don't hedge, just benchmark. After benchmarking, let time lapse. The liability is long term. It's not an immediate payment. The liability is long term. So what you can do is you can target that this is 4.5% is the cost that I have to pay if I hedge immediately. What I'll do is this 4.5%, I'll try to reduce it to 1% or 2%. Okay, because my liability is long, I can wait for a while. If I wait for 3-4 months, then 3-4 months premium comes down. Okay, and what happens is the currency moves both ways. Okay, so you get dollars to levels to buy dollars, and you get levels to sell dollars also. So there is a time decay for reduction of forward premium, and there is also an opportunity to hedge at a much better price than hedging at the first day. So this mechanism is a very effective mechanism. I have a target to shoot. You know, risk management or any decision making becomes very difficult if you don't have a target. If you say that I want to hedge at the lowest rate, exporter wants to hedge at the highest rate. Ladies and gentlemen, no one knows what the lowest rate is or what the highest rate is. Okay, so that is like shooting in the dark. You can't hedge. But once you have a target, once you have a methodology, once I know that if I hedge immediately, I have to pay 4.5% as the premium. What if I wait, let the time lapse, let me get a better spot? My liability is long term. There is no hurry to hedge. Okay, and we have seen historically the forward premiums have been usually higher than the risk of rupee weakening. So it makes all the more sense to take that chance. Remember, you are taking a chance. You are taking a chance. You are taking a calculated risk. And I'm taking the calculated risk depending upon historical data, how dollar INR has moved or behaved. Okay. Now, typically what we suggest is whatever principal repayments are there for the next 1 year, you can look to selectively hedge those. Okay, let's say you have a 3-year loan or you have a 5-year loan. There is no point hedging for 2024, 2025, 2026. You end up paying a whole lot of forward premium. Okay, and we know by history, the currency does not depreciate that much. So one of the good ideas to suggest to hedge on long-term basis should be to look at liabilities which are due to be paid in the next 1 year. Okay, and as I said, the dollar INR makes ample movements on both directions. Okay, you get a lot of opportunities, and we are looking at 1 year payment, we are looking at 9-month payment, 6-month payment. Market tremendously changes in 3-4 months. As I said, now it is 74, 73, 90 on 12th of January. On 15th of December, 16th of December, it was 76 plus. So those were fantastic levels to sell dollars. And now it is a very good level to buy dollars. So in just about a month and a half, you get a fantastic level to sell and you get a fantastic level to buy. So this methodology works very good and very comfortably. And this is something which is tried and tested. And I myself had applied it on my corporate side, where I had a lot of more than 200 to 50 million of liabilities sometimes. And I have seen a lot of treasuries and a lot of smart people using these kind of methodologies. Okay. Now, there is one more reason why we suggest hedge for less than 1 year. And that is, understand the forward markets are very active till the next 1 year. Beyond 1 year, the market participation is very small. Okay, it is like 99.5% does 1 year and 0.5% does more than 1 year. So if the participation is very small, there is a whole lot of problems of illiquidity, lack of transparency of quotes. So practically to do it, you might incur a lot of hedge cost unnecessarily, and you might also incur a lot of additional banking charges because of lack of transparency. Okay, so hedging long-term liability makes a lot of sense, but apply a methodology. I gave you a first day forward rate methodology. There are other methodologies as well. Think of it. I've given you an idea. You can ideate. Understand there is good reasonable volatility on both sides. Understand long-term, the currency has not weakened to the extent of the forward premium. So it makes more sense to hedge up till 1 year and keep the later portions unhedged. We can hedge it later. Whenever the market gives you an opportunity, there is a good time decay also. So you can hedge it later. Great. So, okay. Now, this is another very interesting aspect that I wanted to talk about, especially at a time when the subvention was there and then suddenly the subvention disappeared. So how do I optimize the interest cost on my exports? Now, this is predominantly working capital. Till now, I have been talking long term, which is like projects. This is more on the working capital side. This is short-term funding. Now, all exporters, whoever wants some kind of a short-term funding, there is a very easy availability of packing credit. But the biggest question is, in what form should I take the packing credit? And since it is a loan, my sole objective is to reduce the interest cost. I need to reduce the interest cost as much as possible. Since it is a liability, it is a loan. So you can take packing credit in the form of foreign currency. You can take packing credit in INR as well. And since, as I said, it is a loan, I need to work out the mathematics in terms of what is the actual interest cost of the loan if I take in foreign currency, and what is the interest cost of the loan, effective interest cost of the loan, if I take in INR. Now, till very recently, till the 30th of September, we had an interest subvention scheme by the government of India for all packing credits taken in INR. Unfortunately, after 30th September, it was stopped. So all of us have to rework the mathematics of the funding of export credit. Okay, so this slide and the next slide, this slide tells you what should you do when the subvention scheme is there? And the next slide will tell you what should you do if the subvention scheme is not there. Okay. Now let's take one by one. The first option is PCFC. I can take a packing credit in foreign currency. Simply take a foreign currency packing credit. Let's take I take a $1 million packing credit now in foreign currency. It gets converted at current spot. Okay, I use that liquidity for my working capital, for run my machines, pay my labor, whatever, blah, blah, blah. I make my product, I ship my product, I get my receivable after, let's take 4 months. That dollar comes in, that dollar directly repays this dollar. I get 1.5 million, 1 million goes to repay the dollar loan. And for 4 months, I pay the LIBOR cost, LIBOR plus spread. So LIBOR, sorry. LIBOR again typically is very close to 0, or the short-term funding rate as we call it now is very close to 0. So 2.5% is the normal spread. So the total cost comes to anywhere between 2 to 2.5%. Okay, PCFC cost of funding in foreign currency. Now what happens if I take the packing credit in INR? So I have made 2 classifications. I have made MSMEs and non-MSMEs because the subvention for MSMEs was 5 and non-MSMEs eligible codes, the subvention was 3. Okay, so typically MSMEs used to get packing credit in INR at 7-8% and they get a 5% subvention. So it is 7-8% minus 5%. And non-MSMEs get it as around 6 to 7%. So it is 6-7% minus 3% for them. Now, there is one step still left. Only subvention should not be reduced. What happens in PCINR is you take a packing credit loan in INR. Let's take, I take 10 crores of rupees now. Okay, I took packing credit in the form of 10 crores and I used it for my working capital requirement. This 10 crores, when after I ship and transmit my material or my product, I get foreign currency in the future, as I said, after 4 months. For that future receivable of foreign currency, that has to be converted to INR and then paid this INR loan, this packing credit loan. So what I can do is, I can take a simple forward for the conversion of the receivable after 4 months. I get 4.5% of forward premium. So effectively, my interest cost is 0 or negative. After subvention and after taking a forward contract and encashing the forward premium, my effective interest cost is 0 to negative. This is a superbly efficient management of your working capital cost. Now, after 30th September, whenever I've made this webinar, whenever I've showed this slide, everyone has asked me, Mr. Victor, there is no subvention now. So what should I do? Okay, very simply put, this is the methodology, what I explained just now. Take packing credit in INR, convert that to an equivalent dollar at the current spot, and then just take a simple forward for the maturity. So you get that 4 to 4.5% forward premium. And after your maturity, whenever you get your remittance receivable, just convert using the forward rate and repay your packing credit. So you get a 5% or 3% subvention and you get a 4.5% forward premium as well. So your net interest cost effectively is 0 or close to 0. Okay. Now this is the case when there is no subvention. Okay. When there is no subvention, what happens? Actually, when there is no subvention, it is almost the same. The PCFC cost and PCINR cost is the same because there is no subvention, but forward premiums are still there. Okay. So what we tell all corporates, all exporters is a very simple thumb rule. Okay. If interest subvention is there, then certainly avail PCINR, packing credit in INR, get the subvention benefit, take the forward, get the forward premium benefit. Your interest cost is very low, almost 0, or certainly 0. If interest subvention is not there, I have written avail PCFC, but what you should do is you should do your mathematics. If interest subvention is not there, what is my PCINR rate? What is the forward premium I get? for PCINR rate minus forward premium, what is my net rate? Similarly, you have PCFC cost, LIBOR plus spread, whatever is the total cost. So it's a simple comparison of cost to cost. So even if the subvention is not there, I have seen a lot of companies getting packing credit in INR at 6%, 6.5%. So even if you get packing credit at 6.5%, 4.5% is the forward premium, your interest cost comes to around 1.5 to 2%. So if your PCFC cost is more than 1.5 to 2%, you can still continue with PCINR. But if PCFC is cheaper, then obviously take PCFC. The basic bottom line is, whenever you are taking a packing credit, understand it is a loan. Just work out the cost elements, just work out your computation mathematics. Whichever is cheaper, just take it. Okay, but one thing is very clear. If the subvention is there, then it is certainly PCINR. Don't take PCFC, but certainly take the forward as well and encash on the forward premium. Okay, so that is the thumb rule. I hope all of you understood that. Then I'll just invest about 4-5 minutes to give you a small idea of our mobile application. Let me just have some water. Remember, during the beginning of my presentation, I indicated about a challenge about the lack of transparency about rates. And to be very honest, ladies and gentlemen, the challenge is very large. People are unaware about the rates. You still look at the public domain, public platforms, and take it from me, none of the public platforms will give you real-time prices. And the public platform will just give you one rate. You will not know whether it is spot, whether it is for exporters, whether it's for importers, what is the cash spot, what is the margin. You will have no idea. So what we have identified is we have created a mobile application which overcomes these challenges. It gives you real-time prices. Okay, it gives you real-time prices. So all of you exporters and importers, whoever has forex conversions to do, I would very humbly and very strongly request to download this application. It is free of cost as of now. You can download it from Play Store as well as from App Store. It is there in Android as well as in Apple. Okay, you can download by the name from MyForexi. This will give you real-time prices. Okay, and it will give you real-time prices for export, imports for whatever currencies you can think of. It is a very user-friendly application. We have invested a lot of time and effort for the last about 3.5 years. And it is very well acclaimed by a lot of exporters who do it, regular export and import transactions. Very important thing, another thing what we have incorporated in this is, wherever you want a forward rate. See, in India, spot rate is a smaller challenge. The real big challenge is getting the forward premiums. If you have an export receivable or an import payment to be made on 30th, let's take 15th of May. If I want to hedge it today, you have no idea what is the premium for 15th of May. Okay, this app will give you the premium calendar for the next one entire year. Any currency pair, any maturity for the next 1 year, it will give you the premium calendar. Okay. Another thing, very interesting what it does is, the system will work for you. Let's take the spot now is 74 and an exporter thinks that I do not want to hedge at 74. Okay, I want to hedge if the spot touches 74.50. You can put a rate alert in the system. You can put a rate alert in the system that whenever spot touches 74.50, please notify me. It will send you an in-app notification. It will send you an email as well. So it can be used by exporters and importers to set rate alerts. You can make the system smart enough to work for you. You don't have to look at the rate throughout the day. The system will do it for you. Okay, then there is a lot of ideas on forex trading. A lot of people have now started to trade in equities. They were already trading in equities. Now they have started to trade in currencies. There is a very liquid, very transparent, and a massive currency market in India. So you can trade currencies. You get trading ideas by experts here at MyForexi. You get trading ideas, which futures to sell, which futures to buy. You can trade on currency volatility to make money. Okay, there is a personal, we are a RBI authorized money changer. So whenever you need foreign currency for international travel or transmission purposes, you can use the application and you can directly book the rates here and do the transfer themselves. Okay, so there's a whole lot of things on the application. I'm sure you will have a lot of questions. Please take down the questions towards the end. We will answer all the questions one by one. Okay, Praveen sir, that is it from my side. I hope I was within time.
Yes, very much within time.
Okay, great. Usually I'm not. Usually I tend to overstretch. Thank you.
Right. Thank you so much for wonderful insight into Forex and how to hedge and take forward and how to cover your costs, interest rates also going forward. Thank you so much, sir.
Thank you. Most welcome, sir. Most welcome. So I will stop sharing this. I will give Priyatu to take it over from here.
Okay, right.
Just 1 second. I'll just take the ownership of the screen so that I can. Ritesh, can you just pass me 1 second? Can you pass me the host?
Okay, sure.
And before that, Mr. Ritesh, if you can have a look if there were any requests for joining while you were giving presentation.
Yeah, sure. I will do that. There is I think one question. Okay, that you have written. What we can do, Mr. Praveen, is if people have questions, they can even type it out on the chat box. We can address that way. Or if they want to address it verbally and orally, then I can come back in probably half an hour. And anyone can ask verbal questions directed to either Priyatu or me, and we can take it up one by one. Whichever way is suitable, I leave it to you.
No. What I was saying was not about questions. If somebody was, joining in, you had to approve it.
Yeah, that I did.
That you did, right? Thank you.
Right.
Thank you.
So I'll just begin my presentation. So good afternoon, ladies and gentlemen. Thank you so much for joining us. Ritesh from our team, Ritesh looks at the foreign exchange part of the business. I look at the trade finance part of the business. As Mr. Arora just mentioned and gave a brief background about myself, I've been a career corporate banker all my life. I've worked with a few large MNC banks in India, and I've had a good exposure into international trade and working capital management. So I'll try to make this presentation a more of a an information purposes presentation, focusing specifically on some of the aspects that MSMEs might find challenging in terms of arranging financing and the product mix that you should probably opt for. Ritesh did mention a little bit about the packing credit part of the business and how the cost calculations along with the foreign exchange forward rates stack up. I will just cover some of the other products in detail. So before we just began, specifically from a project exports perspective, I just thought, I just outlined a few risks. We'll not spend too much time on these aspects because these aspects are fairly familiar with you. But a couple of points where I would like to highlight is the first part, which is the financing risk and the performance risk. Now, in terms of, these are some of the challenges that you face and some of the risks that you face in international trade. Now, financing risk, from what I understood from the brief discussion that I had with Mr. Jacob, is there are two challenges that most of our participants today probably face. The primary challenge is the arrangement of financing so as to undertake a large project overseas, and the second is how do you go about selecting the right instruments? Because from a timing and the risk management perspective, the financing that you have arranged generally tends to be a short-term in nature financing, whereas the project tends to overrun and overshoot its timelines, thereby resulting in delayed payments. So there is, of course, a funding gap that you have in between. So these are the two financing risks that most of you perhaps have experienced or perhaps will be experiencing. And the second is, of course, the performance risk and how the beneficiary of the project, kind of mitigates that risk by ensuring that you tender various bonds, like a bid bond or a performance bond or a retention bond. So we'll just cover some of these aspects in the products subsequently. Now, again, this is also a fairly basic thing, which I'm sure all of you are aware, how the settlement process in an international trade functions. If you have a project, you could probably be paying in advance, getting the receivables in advance, or you could probably just be sending the documents without the cover of a letter of credit, just on an open account to the beneficiary, and the beneficiary would perhaps be settling the transaction. In this case, because you are project exporters, so you perhaps would be sending the documents to the importer and then getting the payment released by the importer from that country. Now, again, there are various pros and cons of all these practices. But in an international project, I would understand that some of these points are not applicable, like payment in advance, open account are not applicable, because most of the projects would be on a specified milestone-based approach, wherein you would be getting paid at certain intervals of time, and there might be some security cover that might be available to you from both the payment certainty, as well as from your liability perspective, you would perhaps be required to tender letters of credit, because some of these projects are larger value in nature. So we will just go to the next slide, where we've covered letter of credit and letter on site basis, and letter of credit on USANS basis, and standby letter of credit. So I'll just take a minute to detail on both the site and the USANS part. Now, let's say you are an project exporter. You have been contracted with a project in an overseas market, and you would, of course, need to get various materials in order to execute that project and deliver on the project. Now, there are two components to that entire package. One is, of course, the manpower and the technical side of the business, which you perhaps would already be taking care from your existing operations. And then the second would be the goods that you have to incorporate and package and sell. So these, in all probability, would be capital goods in nature, which again would lead to the question that these are extremely high valuable items. Now, the supplier of these commodities could, if they are not local, they perhaps would be from countries like in the Eurozone or China or some of the other countries. Now, these capital good products are generally backed by letters of credit. The supplier of these goods would generally be telling you to furnish a letter of credit on a site basis. Only then will the shipment be made, and there would, of course, be a certain element of advance payment that you will need to make to them. Now, the point that I'm trying to make here is that they would be insisting on a site letter of credit, or maybe with a 30-day term period built into it. But what I wanted to bring to your table is that you could, at that point of time, negotiate with your supplier and propose to them another structure, which is called the UPAS LC. UPAS LC is USANS LC payable at site. Now, how this structure essentially works is, you have the supplier who wants to get paid on, let's say, site, or he wants to get paid on 38 days. And you obviously would, because your receivables are nowhere as near to the payment date, your receivables are generally longer term in nature. You, of course, want to enjoy the period of financing from a particular bank, wherein you will be able to get a reasonably decent cost of interest. So your objective is to delay that payment from your balance sheet, whereas the supplier's interest is to get paid on site. So how do we bridge this gap? This gap you can easily bridge by international product, which is called UPAS LC. So how this works, sir and ma'am, is that you basically have to negotiate with your supplier that you will get a LC. So you will be guaranteed the payment of the product. You will also be guaranteed the payment will happen on a particular date, and that particular date will be as per your existing terms. However, your the LC would be USANs. So the way it is structured is that there are a few clauses that we insert in the letter of credit, which essentially goes something like this: that even though the tenor of the LC is 180 days from the shipment date, the supplier will get paid on production of documents within sight. So essentially what happens is there is another negotiating bank from an overseas jurisdiction that is introduced into the picture, that enters into the picture, pays off the supplier on the normal payment term, which could be sight or 30 days, whatever is the arrangement, and on due date, so they will claim payment from the LC issuing bank, which in turn is you. So you generally are able to extend your payable by whatever the amount is, whatever the working capital cycle in that particular product is. Now, because some of these products are longer products in nature, depending on your existing bank, you would perhaps be able to get up to 3 years of credit, because these are capex goods in nature. But some banks may also treat this as a working capital arrangement for you. In that case, you will be able to extend this payment term by about a year. So this is one area that we have effectively helped some of our clients to use. And in international market, if you remember Ritesh's slide, the short-term funding rate, the LIBOR is close to about 0.2%. The spread prevailing in the international market for virtually almost any client, for a bank in this particular example, would be anywhere between up to 50 basis points to 1%. So overall, from a risk management perspective, you are getting this funding at 1.5%, which is definitely cheaper than what you're getting from your onshore sources in Indian rupees. So this is one area that I would strongly encourage all of you to have a look as to how to convert your existing payables using letters of credit and financing your existing payments using letters of credit and extending your payment terms. That's one part. The second part is the standby letter of credit. Now, this essentially refers to a financial guarantee. There are two types of guarantees, as you are well aware. One is the performance guarantee, which is the one that you give on bidding the project, as well as once you won the project. These are guarantees that are basically to ensure performance of the project winner. Then second kind of guarantees that is there is the financial guarantee. Now this is again an area which you can use to avail international financing. The reason why we keep emphasizing on international financing is essentially for a simple reason. As you are well aware, over the last 10 years, because ever since the 2008 crisis, the global central banks have been pumping money in various markets through various instruments, through various repurchase programs, through various programs such as infusion of capital to individuals. So globally, if you were to see, global markets are currently flushed with funds. Of course, they're going to put a stop to it, but it's not going to happen anytime soon. The entire liquidity that is available in the global market is not going to dry up anytime soon. So what this essentially presents to us as is an opportunity. The opportunity is that overseas interest rates are at rock bottoms, historical rock bottoms. And whereas the Indian rupees interest rate has also come down, but it has not come down to those levels that are available in the international market. So this arbitrage that you have, which is why we keep guiding our clients, and that is what our guidance to all of you also is. Have a look at your entire portfolio when you're bidding the projects or when you've already won the projects, and try to see which of your liabilities, which of your financing you can convert in foreign currency. And through various means and mechanisms, you could introduce a letter of credit for your normal purchases to avail a supplier's credit. You could introduce a standby letter of credit, which is essentially a financial guarantee to avail buyer's credit from international bank. So these are some of the aspects that we thought that will bring your overall cost of borrowing down to reasonable levels, so as to make the project margins attractive. Now I'll just cover some of the existing banking financing solutions, starting from the short-term financing that you are already have in mind, and how you can use some of the outside bank solutions or some of the non-banking finance solutions to bring down your overall cost of financing. So the existing banking instrument, this is something that all of you are fairly familiar with. You have the opportunity to draw down your cash credit, overdraft, working capital demand loan, export credit, term loans. On non-fund based side, you have letters of credit, bank guarantee, and of course you have foreign exchange limits to hedge these exposures that you already have. So this is existing operation that you are already fairly familiar with. I'm not going to spend time and effort on this because this is something that you're fairly aware in, and these are all denominated in rupee, except for the export credit and the import credit. I'm going to focus on both of them in the subsequent slide. Now, export credit, this is financing that you take for essentially packaging the pre-shipment finance that you take, and the post-shipment finance that you take. Ritesh did mention under what circumstances you should be looking at, making the choice between a PCFC or a packing credit in rupees. Again, it depends on various circumstances, such as subvention being available or not, whether you are an MSME or not, whether the product that you are supplying is attracting subvention or not. And overall, the guidance factor is that whether subvention is available or not. Again, if you do the arithmetic, you will come to the same conclusion that Ritesh briefly outlined. When subvention is available, and if you are eligible for subvention rates, of course, go down the path of taking it in rupees and hedge it at the same time, so as to get near zero cost of borrowing. If subvention is not available, then of course you have to match it with the existing packing credit in foreign currency rates and see whether after hedging your overall cost is lower than the packing credit or not. You see, in India, banks have an export asset book to maintain as governed by the RBI. So RBI mandates all banks to have priority sector assets. One of the priority sector assets is export assets. So if you will notice, towards 31st of March or quarter closing or mid-year closing, banks offer very attractive rates as far as packing credit goes. And that is actually the time when you should definitely look at those options. But overall, during the year, packing credit comes back to normal levels. Now, if you are eligible for funding under subvention, the best rate in PCFC cannot match the best rate in packing credit in INR, purely because of the fact that you get a clean subvention credit and you also get the forward premium from the market. So that is something that you should definitely look out for. Now so these are the, so everything that we have talked so far is something that you are already aware of. Be it in terms of packing credit, be in terms of term loan, be it in terms of rupee loan. Now, how can you use some of the outside bank facilities or maybe non-banking solutions to bring your overall cost of borrowings down? That is what we are going to focus on the next couple of slides. Now, I'll start with exports. So there are two products that I would like to bring to your attention. One is export LC discounting. Because you are in the business of export, some of the projects that you might be undertaking might be backed by letters of credit, which essentially means that the beneficiary of the project would be issuing letters of credit in your favor. Now, how do you get this LC and the payment under this LC discounted even before this is actually guaranteed to you under the letter of credit? So there are two ways to go about this. First is, of course, you can approach your existing bank to discount the LC. Of course, this is not the ideal method to do it, because this is what they will do is they will discount the letter of credit by blocking your existing banking lines. So which means if you have, let's say, 20 crore of facility with a particular bank, if you go to the same bank to discount that letter of credit, they will block your lines, and it will be a with recourse facility to you. So this is generally termed as bill discounting under LC by banks, and you would be suffering at the end of the day because you would not be getting the best rates in the market. A, and B, your existing credit lines would be blocked. So how do you take advantage of lower rates available in the market, and at the same time not be not blocking your existing limit? Because availability of credit, like we what I was given to understand, is a big challenge as far as the execution of some of these projects goes. So this is what a product that you can have a look at. So a firm like us, MyForexai, what we generally do is we assist clients in getting the letter of credit discounted through various banks. We have dealt with multiple banks in this regard. We know which bank's liquidity position allows them to discount some of these letters of credit at a much cheaper rate. So what we do is, when you approach us to get a letter of credit discounted and the bills under that letter of credit discounted, you have already delivered your part. So you've already performed. So all that is left is the discounting of the post-shipment transactions. So what we do is we approach multiple banks on your behalf. We arrive at a cost that is most lucrative to you, and then we will enter into an arrangement with that bank on your behalf. We might get a few terms in the LC amended, and these LC terms amended will not change the overall contour of the transaction. The transaction will virtually remain the same. Now this bank would do a limited KYC on you, and would perhaps be some banks insist on opening of a bank account, and some banks are okay with relieving you of that responsibility. However, the discounted proceeds will be sent to your existing working capital banks. So therefore, we will not be depriving of your existing bank of the cash flows. However, you will be able to enjoy a rate which is far lower, and your existing banking lines will not be blocked because of this. So this is something that you can have a look in case there are certain transactions in this field. The second one is similar to LC, but there is no LC in that transaction. These are all open account transactions. You have delivered on your project. Now all that is required is there will be some time gap in terms of payment going to be received from your the person who has commissioned the project. So let's say you are going to get paid at 6 months interval. You have delivered, you've received your milestone based payment. The rest of the payment will, let's say, come after 30 days, 60 days, 90 days, or 180 days, whatever is the arrangement. Now, this is something where a factoring company comes into play. The factor company will essentially screen the person who's going to pay, which is the importer in our case. And if the importer has a good credit standing, would then underwrite these limits and directly pay you off. Now, the discounting factor, the way it works is, once you have delivered on your performance, once the invoice has been accepted for payment by the seller, you will then tender those invoices to the factor. Factor will discount those invoices and will advance, say, let's say, up to 90%. Some factors give 80% advance, some factors give 90% advance of that money will be immediately credited into your account. On due date, the seller will then pay to the factor, and factor will then deduct its interest and remit whatever is the balance back to you. So this is overall how this factoring market transaction works. Now, 2-3 key aspects of this financing, this type of financing is, at the time of entering into such arrangements, you should definitely view it as a true sale. You should definitely get it structured as a true sale. What do we mean by true sale? Is that these are off balance sheet items for you then. So you have effectively turned your debtors into cash and freed up your, the baggage from your balance sheet. You have absolutely realized your sale. So this has to be structured in that manner. Of course, there are with recourse transactions as well, but to get the true benefit out of such assignments, you should definitely look at a true sale. Now that once you are able to do that, you have completely freed up your cash flows. You have completely removed the debtor from your balance sheet and converted into cash. That is one aspect that you should look at. So essentially, what this means is you have a much lighter balance sheet on your perspective. And secondly, this is outside of your existing consortium financing. This is allowed by the Reserve Bank of India. This is allowed by the Government of India. So this is a very alternative, attractive means for finance that you can undertake. And of course, the funds will be remitted into your bank account, so your working capital bankers are also happy. So this is another area where you can, explore on the export side when you look at a transaction. Now coming to the import side, because you would be commissioning these projects, you would be importing a lot of materials to deliver and commission and execute under these projects. Now, how do you go about financing those projects? So the simplest and the safest way to do this is to go to your bank and take a rupee term loan or a rupee demand loan or a rupee working capital loan and be done and dusted with it. But then that is a very expensive proposition. Like I was explaining, a little earlier, the international markets are flushed with liquidity, and the rates in the international markets are far lower. So how do you take advantage of those aspects and bring your overall cost of borrowings down? Again, there are two ways to do this. One is through buyer's credit and supplier's credit. All these products that we are discussing right now are obviously approved by the Reserve Bank of India. There are various circulars by the Reserve Bank of India which allow these transactions to happen. Now, this is something which is already available to you, but from a convenience perspective, some of these products are generally not made available to the routine importers because there are certain complexities involved which you'll have to undertake. Now, let's come to first buyer's credit. Now, buyer's credit, now how it happens is essentially these are financing that is arranged by an overseas institution, but these financing institutions are going to not finance you directly. There is a differentiation. They are going to finance the bank that you have. Basically, they're going to finance your bank. So how this will work is you get your existing bank to issue a standby letter of credit in favor of the overseas bank. The overseas bank, on the basis of that standby letter of credit, will extend financing based on your import bills to that bank. And that bank will go on to pay your import transactions. And the cost of interest in this case is denominated in short-term, foreign currency rates, which is roughly about 0.2% to 0.25%. This could, of course, change. And then there is a spread over LIBOR. Now, the better the bank that you have currently, the better the rate the spreads are. So the spreads could be anywhere between 20 basis points to 1%. So if you have a very good bank at your disposal, so you are basically talking about financing as low as 0.3% per annum. This is far removed from the cost of financing that you perhaps might be getting from your banks in terms of INR. So this is another area that you can look at. There are certain complexities post the Nirav Modi scandal involving Punjab National Bank, but now largely the banking infrastructure is geared up to meet some of those shortcomings. So essentially how this process works is your existing banks would issue an SBLC. The existing bank would produce the various documents that you have produced with them, and then these documents will be scrutinized by the overseas bank. They will, just a minute, somebody wanted to join the meeting, I've just added. So the overseas bank will scrutinize these import documents, which was not happening earlier. This overseas bank will also scrutinize the SBLC that your existing bank has furnished. Now, earlier it used to go in MT 799. Now it goes in a specific structured format to the overseas bank. So once all those scrutinies are done with, then they will extend this credit. This credit is extremely cheap and effective. Now, how MyForexi assists you is that MyForexi is in touch with almost 100 plus overseas banks, various branches of Indian banks, as well as foreign branches of foreign banks. And we are able to give you a competitive quote based on the jurisdiction that you're operating and executing your projects in. So for example, if you are working out of Africa, we would probably be able to get you a quote out of Johannesburg. If you're working out of, let's say, Asia, we'll be able to give you get a quotation for you from, let's say, Sydney, Singapore, Hong Kong, and Japan, wherever your preference lies. And that is how we are able to help clients, and how you are able to help yourself by lowering your overall cost of borrowing. Let's just cover the supplier's credit. Supplier's credit is more or less similar to buyer's credit, but instead of a standby letter of credit that your existing bank is issuing, here there is an LC. There is a letter of credit that is governing the entire transaction. Now, in supplier's credit, here you will also need to get the cooperation from your supplier. Now, again, I had alluded to this earlier. Your supplier says, look, I need my payment on site. So you have to convince your supplier that, okay, you will get your payment on site, and the letter of credit will clearly say this. However, the letter of credit tenure would be, let's say, 180 days. But there will also be a clause in the LC which will say that even though the letter of credit usance period is 180 days from the date of shipment, the supplier would get paid on due date or on site or at 30 days, whatever you want to add there. So the supplier is assured that as long as they are submitting the documents in order, they will get paid as per the existing arrangement. Whereas the gap that is there, that is the payment being made to the supplier, and the payment when you have to make, that gap is funded by an overseas bank. So the LC will have another bank, which is the negotiating bank, into the picture. So there will be three banks. One is your existing bank, which is the LC issuing bank. The second bank would be the LC negotiating bank, which will be the financing bank. And the third bank would be the beneficiaries bank. And all three will come together. The financing bank will extend the credit, extend the loan on your behalf, will make the payment to the supplier, and on due date will collect the proceeds from the LC issuing bank, which in turn will collect it from you. So this is the process for. Again, due to the involvement of an overseas bank, we at MyForexi have done such transactions wherein we get quotations from various banks, and whichever is most suitable to you in terms of pricing, in terms of location, that is something that you can look at. The costing principle operates very similar to the buyer credit, which is the funding rate in the market. Earlier it used to be LIBOR. Now various yardsticks are used, like short-term funding rate or long-term funding rate plus a spread. It depends on the bank quality, the LC issuing bank's quality. If the bank is good, the funding rate could be as low as, the spread could be as low as 25 basis points. If the bank is average, the funding could be, cost could be higher. So roughly here also you are able to secure funding at a fairly attractive rate. Now, another element of course, that so basically how are you benefiting in this supplier's credit and buyer's credit versus simply borrowing in a local currency, which is the Indian rupees, right? So let's say your rupee cost is, just for argument's sake, is 7.9%. Whereas the supplier credit cost in the example that we just undertook, let's say the LIBOR or the short-term funding rate is 0.2%. The spread over LIBOR, let's say, is 0.8%. I'm taking it on the higher side. So let's just say 1% is your funding interest cost. You add to that the LC issuance or the SPLC issuance cost. Normally it would range from 50 basis points to 1%. Let's take it on the higher side. Let's take it at 1%. So you have 1% funding cost, 1% issuance cost, so which is about 2%. Now, essentially what you are currently doing is, instead of making the payment today, you are now getting a credit so that you need to make this payment 6 months down the line. So you are actually exposed to 6 months of foreign currency exposure. Now, let's say you take an extremely conservative stand and you want to hedge this on day one itself. So the day one hedge cost for a 6 month would roughly be about 4.25% to 4.5% in dollar rupee. You add that also to this. So you have 4.5% plus 2%, which is 6.5%. So you have a fully hedged foreign currency loan at 6.5% versus a 7.9% local currency loan. So that spread, that difference of 1.4% is a significant one. And that is where we we guide our clients on how you can use international financing opportunities to bring your overall cost of financing down. Now, moving on, some of the long-term financing solutions that are available to you are essentially I'm not going to talk about the rupee financing options because you, I'm sure, are fairly familiar with those options. The two options that you have currently are foreign currency term loan, and the next slide is basically ECBs. Now, again, there are very, very complex regulations surrounding both of them, especially in ECB. But I'll tell you the brief difference between the two. Foreign currency term loan is given by onshore banks. The source of dollars is onshore dollars, and this is generally given to for, let's say, an import of capital goods, or let's say you want to retire your existing rupee term loans, or you want to retire your existing external commercial borrowings. This is generally for those purposes. Now, because the currency involved is foreign currency, obviously the currency interest rates are on the lower side. Now, again, the whether you want to hedge or you don't want to hedge, again, is a question left up to you. But even if you say were to hedge through various products that Ritesh was mentioning about, which is your interest rate swap and the principal swap or a complete swap, if you were to take a very conservative approach, even then these options are fairly cheaper than just outrightly borrowing it in rupees. Now, ECBs, on the other hand, are given by external lenders. Now, external lenders, there is no shortage of dollars, unlike the onshore dollars. So, external dollars, the rates are even more competitive. And therefore, ECBs are very attractive ways to raise financing from overseas market. Now, all these structures, there are various structures that are available in the national market that Mr. Jacob and Mr. Kumar was also alluding earlier. Some of these projects may be backed by ECGCs of various countries. Now, India, you have Exim Bank, who would perhaps be guaranteeing some of these projects in terms of an insurance cover that they will provide to you. Now you will take that insurance cover and you will go to an existing bank to get financing on back of that. You have to so those structures are also available in the market depending on the size and the nature of products. But to sum it up, what I would essentially say is, wherever possible, look at options to select your banking instruments. It could be by way of selection of packing credit in Indian rupees, because subvention credit is available to you. It could be by way of selection of suppliers credit over a normal rupee loan, because you are able to bring down your interest costs. It could be by way of selection of ECB over your long-term loan or a simple term loan in rupees because of reduction of interest cost, and how to go about hedging that entire structure. So these are the two aspects that you have to look. And once your overall costing is down, you of course will find that you are in a better position than you are on an existing basis. So that's it from our side. And how we play a role, I've covered this earlier as well, but what we do, I'll be honest with you, we are a firm that is more into advising on how to select and what products to select, but we are not in the business of arranging financing for clients. However, should there be a requirement that some of you might have, we work with various partners in the industry. We would be happy to, introduce you in case there's a requirement. The role of MyForexSci is essentially to bring about a transparency as far as foreign exchange rates goes. So if you see our mobile application that Ritesh mentioned to you, it is essentially to bring about a transparency in the way the hedging, the conversions, and the forward premiums are available to clients. So that information providing is something that we do. The second thing that we do is we give advisory on foreign exchange and how to bring your overall cost of borrowing by using various banking instruments to like suppliers credit, buyers credit, factoring. We arrange for best quotes from export factoring, export LC discounting, buyers and suppliers credit. And finally, and perhaps more importantly, this entire thing is not a one-stop shop that you do something today and then you forget about it for the next 6-7 months. The entire thing is in evolving dynamics is there. Now Ritesh mentioned to you that within a span of 1 month the rupee moved from 76 to 74 levels. So there is a gap of roughly about 2.5 rupees that the rupee had showed a movement. Similarly, in terms of interest rates, the interest rate in the international market could move from 0.2 basis points, 0.20 to 1%. Now, how do you keep a tab on all these factors? How do you move in and out of various products, various instruments? This is something that we at MyForexi assist and guide our clients through. So that's it from our side. I think we've covered both the foreign exchange part as well as the trade finance part. Some of the longer term solutions of financing we've discussed with Mr. Jacob and Mr. Kumar. We could perhaps have a follow-on session to cover some of the longer term aspects of financing in a subsequent presentation. So now I think I'll just open the floor to questions if there are any.
Yeah, thank you. Thank you so much, Mr. Shekhar. Can we now have, any questions that our attendees may have? I'll request that, they could either raise their hand or send your name in the chat box so that we could take up the questions one by one.
Praveen, I have one question to Shekhar.
Yes, please.
Yes,
go ahead, sir.
Shekhar, you mentioned that when you have a letter of credit.
Yes, sir.
And you make the shipments and you bank with, let us say, Axis Bank and some other bank offers a better rate for this, you'll be able to do it. And that too without any limits. Now, can you just a little more explain this? Because I find this is a little tricky because first my understanding was that when you discount a bill under a letter of credit, there is your limits are not blocked. So that's number one. I mean, of course, it depends upon the LC issuing bank's credibility and kind of thing. That's number one. Number two, exporters find it difficult to change the bank because it's not that easily being done. Can you a little more explain this?
Sure, sir. So, so there are, like I mentioned, sir, you are absolutely right. Now, you have to break it down in a very technical term. So, there is a letter of credit. Now, what the letter of credit essentially says is, on the due date, if the payment is accepted by the letter of credit issuing bank, on due date, even if the importer fails to pay, the LC issuing bank will pay. So it is a joint and severable liability of both the parties. So essentially, from a banking perspective, we choose the better credit. So we do not know the importer in that particular country, but we definitely know the bank. So what we do is we tend to take position on that existing bank. So I'll give you an example. Let's say you have exported to Germany and you've received a letter of credit from Deutsche Bank. Now, Deutsche Bank is an internationally recognized bank, and it is said in that LC that these bills will be settled, let's say, on 31st of March. Now, they have given their acceptance. So, basis that acceptance, I, as a banker, know that the liability, I do not care or do not know the importer in Germany, but I definitely know that Deutsche Bank is good for its money. So, what I have two options ahead of me. I can either block your limits and give you a with recourse financing, which essentially means that if on due 31st of March, Deutsche Bank or the importer does not pay, I will just recover the money by debiting your account. Or two, if you are insistent that it has to be a without recourse financing, I will mark the exposure on Deutsche Bank and give you credit, which is essentially you are released of any risk. The only risk that is going to be applicable to you in case there is a country risk, because I have not added confirmation in this transaction. or if there is some other jurisdictional risk, like a court in Germany stopping the payment for various reasons, which again is a performance risk. So except for these two risks, I will give you the credit and you can mark it as a true sale in your books. So these are the two options available. Coming to your second part of your question, whether your existing banks will allow you to take this transaction to another bank. Again, sir, it depends on your negotiation with them. RBI guidelines are very clear that RBI prefers your existing working capital banks to do these transactions.
Yeah.
However, RBI also realizes that some of the existing conditions may not be suitable. So RBI allows in case the LC is restricted to any other bank for the discounting to happen. But again, one of the principles that RBI has is that the working capital banker should not be deprived of cash flows. So the arrangement that we kind of are discussing right now is wherein, let's say this, again coming back to this example, this Deutsche Bank LC and your existing bank is Axis Bank. We will get and let's say we are able to arrange financing from, let's say, Canara Bank. So the LC will be restricted at Canara Bank. Canara Bank will finance this LC. Canara Bank will discount by marking Deutsche Bank's lines, not your lines. So you are not their client. Their client is actually Deutsche Bank, and they will extend this credit and they will discount the proceeds, and this proceeds will be sent to your existing working capital bank. So your working capital banks will see the cash flows. So they are also satisfied. You are satisfied because you've got a lower rate from Canara Bank, and of course Deutsche Bank is not bothered because they have to pay on 31st March in any case. So this is how this transaction is structured.
Yeah, Shekhar, I agree with you. This was very, very predominant 20-25 years back. Which people used to change, but not. I mean, they may have.
Sir, technically, you're not changing banks. Your bank is existing to be Axis Bank.
Yeah.
So the payment instructions are mentioned on the LC that Axis Bank is going to be the ultimate beneficiary. So we are not changing any of that aspect, sir. This is very much allowed by RBI, sir.
Okay,
This is something that we regularly do for multiple clients, and the interest rates are fairly competitive in this regard.
All right. Okay.
I think if I were to put it in layman's term, nowadays an option not exercised much by the clients, and the existing bank would not have problem once they come to know that they would see the cash flows. Their business is not going away.
Exactly. So the main problem is that they fear that you are opening a bank account with another bank outside a banking consortium. That is their fear. In this particular case, many banks are cooperative. Some of the banks that we work, they do not insist on opening accounts.
Yeah, Shekhar, the challenge, opening a new account with a bank and all, it's a very cumbersome procedure.
Yes. So many banks that we work with, sir, they don't insist on opening a bank account. So they will do a limited KYC just to know that, you are a genuine player and they're not financing any of the sanctioned transactions. And once they form the limited KYC, they will discount this LC and send the money directly through RTGS into your working capital bank account, sir.
Okay, right.
I have a question for Mr. Ritesh.
Yes, sir.
This is regarding the app, and you said the foreign exchange rates are real time. Now, we also incidentally would have a employer who pays into dollars but converting into from Indian rupees.
Mm-hmm.
And when we say that this is the app which says today this is the exchange rate, we shall be paid on that.
Mm-hmm.
He would simply say that my bank has the rate like this and I can pay only on that one. So what way this gap to be bridged? If the app is acceptable to me or beneficial to me, I would prefer to go by that. But my employer should also equally honor it.
Okay, I'll tell you, sir, how to overcome this challenge, sir. See, whenever we are negotiating rates, we just need to ask 3-4 things. Okay, the first thing that we need to ask is, sir, what is the spot rate? Okay, let's take you are an exporter, right, sir, or an importer?
We are exporter.
You are an exporter. Okay, so you want to convert dollars and want to get a credit today itself, isn't it?
Well, it is like this. We are into project export.
Uh-huh.
and we are executing project overseas.
Okay.
And these project many a time funded by Exim Bank.
Mhm.
And the terms of the contract says that payment means your bill will be made in Indian rupees, but your
Okay.
payment would be in dollars. And nothing is specified from where they will take the rate for dollar conversion. Only it says when at the time of conversion, prevailing rate would be applied. Now, from which bank and whether it would be giving the equal Indian rupees to me or not becomes a challenge.
Okay. Okay. So the conversion happens at Exim Bank and it doesn't happen at your bank?
No, Exim Bank is nowhere in picture. Exim Bank has put up a third party who operate this whole process. And the third party follows its own bank for exchange rate. And that at time is at conflict with the bank rate my bankers have. Even in between, let us say, a bank, State Bank or Indian Bank, there is a difference of conversion rate on a particular day. Forget about the particular time. On a particular day also, there are two differing rates. And I would prefer to have my bank.
Right. You will prefer to have your bank. Hello, you're there, sir? Your voice.
Yeah. Sir, you went on mute. You went on mute in between. Can you repeat your last one or two lines?
See, it is like this, that employer would convert on the date of making payment in dollar,
right,
that day rate of his bank.
Okay.
Whereas my bank may be having different rate, which is more beneficial to me.
Okay.
Eventually, I have a right to get the right number of rupees of which I have done the work.
Yes.
But that if he is following his bank rates, do not translate into that.
Okay. So, sir, let me just explain you a slight bit of how the system works. Okay. At any one point of time, the rate is the same. Okay. Dollar INR rate at any one point of time is the same globally. So whether it is your bank or my bank or Bank of America or for whichever, Bank of New York, whichever it is. Okay. At any one point of time, the rate is same. The only conflict is that when I say that the rate is 74.10, the bank says, no, the rate is 74.00, right? That is the challenge, isn't it?
Correct.
Okay. Now, sir, how you can overcome the challenge is by simply asking your counterparty or your bank a few things, that 74.00 is the rate that you have given me. What is the spot rate? What is the bank margin? Bank margin means what is the compensation that he's charging or the margin that is charging for the Forex conversion. Okay, so you just need to ask 2-3 very simple and plain questions. The banker will himself understand what to do with it. Okay, as of now, what has been happening is we have been just asking, sir, give me a rate. Okay, when you ask the banker or a counterparty, give me a rate, he will give you a net rate. But what we want is, we want to ensure that there is complete transparency and we want to understand, sir, what is the spot rate? What is the bank margin? If the credit has to happen today, then what is the cash spot? If the credit has to happen at the future date, then what is the forward premium? So the simple methodology is to understand the mathematics of the transaction. Okay. Now, what our app also does is, I'll give you another big benefit of the app. Let's take you are negotiating the rate using our mobile application with your bank, and you are not able to conclude on the rates because the bank is giving you a lower rate and the app is showing you a higher rate, which mostly will be the case.
Yes.
What will happen is, you can use, there is a call dealer function in the app itself. You can call my dealing room office and one dealer will assist you in negotiating the rate with you at that point of time.
Okay.
Okay. Now, obviously that will have some set of commercials depending upon the benefit that you get, but the facility is there for you to ensure that whatever rate that is getting displayed on the application, you get that rate.
Right.
Sir, just to add to what Ritesh mentioned, sir, I think your earlier point of that, your contractor is using his own bank's reference rate to convert, whereas that reference rate you have no control over. In that regard, sir, what I would recommend is you take it up with your contractor. You tell them that I am entitled to dollars, and therefore the dollar conversion should be my prerogative. So if at all you are converting it with whoever, you get me involved in that picture. And at that time, you use our application to see the live rates and get the conversion done as per your liking, so that you are not deprived of that, the real rate. That's point number one that I want to make to you. The point number two, I just wanted to add to what Ritesh mentioned is, there, in case you do not want to get into this daily hassle of monitoring the rates and then, calling the banks and haggling with them on the rates, we provide that service as well as MyForexI. All this conversion stuff that you do with your existing banks, that entire bit can be done by MyForexI on your behalf. Once we know that there is a conversion to be done, we negotiate with your banks on your behalf. We identify what is the the commission that has been agreed with the bank, and we will get the price at a particular point of time to you in a fair manner. We will also give to you a complete audit package containing three things: the exact time of the transaction, the actual chart at that time of the transaction. So let's say the transaction you told us that I'm going to get $25,000 as remittance. Can you please get it converted with my existing bank? So on your behalf, our dealer will speak to your bank. We will convert that $25,000. Let's say we convert it at 5 minutes past 2 o'clock. So 2:05, we will give you that actual graph of the dollar rupee, including cash pot, including various, prevailing spot rate and cash spot rate, and the various rate that is available at that particular minute, along with the voice recording of our dealer with your bank's dealer. So with these three things, the voice recording, the timestamp, and the chart, you can be rest assured that you've got the right rate from your existing bank. And this is bank agnostic. So your bank could be Canara Bank, your bank could be Bank of America, your bank could be State Bank of India. We can assist you with this. So there are various features that we have inbuilt with our platform. Again, our application is free for clients. This is only information that we provide to clients. No other player in the market provides you forward rates for exact dates going up to 1 year. All that information is free. You can use our application to meet your immediate short-term goals of putting alerts of, if in case you want a very short-term realization of a rate, you could just press the call button to call us to negotiate on your behalf on a one-time basis. But over a larger scheme of things, if you want to engage us for far more things, you could engage us by outsourcing your entire bank negotiation in terms of foreign exchange to us, or you could use us to just give you guidance on foreign exchange. So various things. But to answer your question, sir, you'll have to take it up with your contractor. Tell him that you are entitled to dollars and not rupees. You please give me dollars, or you allow me to convert dollars at my rate and at my timing, at a time of my choosing.
Of course, that is the option only available to us. But I was looking at this app as a common platform which employer as well as contractor both follow without any reservation. So that
you could use that, sir. You could use our app both for the contractor and you could agree on the time. Let's say 2 o'clock you have to do the conversion. 2 o'clock the rate will be there for you. The same rate would be there for the contractor as well.
Yes, and the same app becomes part of the contract that this is a reliable source at which a conversion shall take place.
Absolutely.
Otherwise, it is ambiguity. You do not know which.
Absolutely, you could use that, sir. Our application provides live rate, so you can use our application as part of your contract also, sir.
Thank you very much.
Any other participants who would like to ask any further questions, please? I think There are no further questions. However, I'd like to make a request to our participants that please feel free to send us a feedback, and any other things that you would like to be included in the further sessions concerning Forex or trade financing, and we'll try and ensure that that topic is covered going forward. And I would now call upon Mr. Jacob George to give his final vote of thanks, kind of ending remarks. Mr. Jacob George, please.
A small interruption, Mr. Anand Iyer. Thank you for the time. Okay, thank you, Mr. Iyer, for the kind words. I hope it was useful and insightful for everyone. We just hope that people understand Forex and trade finance and use the intellect and wisdom for their own benefit. So that is our objective. People should benefit out of it.
Absolutely, Mr. Ritesh, and it was pleasure connecting to all of you, and it was great listening to all of you on this. Thank you.
Thank you, sir. Thank you for the kind words. Thank you.
So, Praveenji, if you could, share our email address, we'll share it with you, with the participants in case they want to get in touch with us. We'd be more than happy to take questions if they have subsequently as well.
Sure, that would be great. That would be great.
So what I'm doing is, Praveenji, I'm just typing out my mail ID. Priyatu, I think you can do that as well on the chat box.
Okay, I'll share my number also with everyone,
Yeah.
So you could probably reach out to us in case you have any questions, sir.
Sure thing.
Okay.
Right. Can I now call upon Mr. Jacob George to give his closing remarks, please?
Yeah, right. Okay. Thank you, Praveen.
Thank you.
We are coming to the end of the very interesting but complex session. Both the speakers, Mr. Ritesh and Shekhar, had given an excellent presentation and explanation. Now, I would like to cover up, touch upon 1 or 2 points. One is that, see, project export, primarily we talk about, council, primarily we talk about project exports. Now, project exports means, it is the execution of the contract itself for a period of time, maybe 2 years, 3 years, 5 years kind of thing. To that extent, the payment also differs. There could also be a combination of payments like advance payment, then could be milestone payments, then could be something about supplies, then could be something about commissioning, services, and effectively, the last payment will come maybe after 5 years, 6 years, 7 years from the first payment. So this is one major challenge the project exporters face. But I would touch upon that. What Shekhar said is that, yes, international business is a very complex subject. If you don't manage your business well, you will lose heavily. And as you rightly said, payment terms, advance payment is the most convenient for the exporter, and open credit is the most difficult for the exporter. Now, of course, in a project exports, of course, we have to have all these combinations of the payment terms. Otherwise, very few contracts will only come to us. So there is also an instrument which has come as a letter of credit to protect both the exporters and importers, or suppliers and the buyers. And you have mentioned about UPAS LCs. Of course, I heard about this 3-4 years back, but then not many people were using very widely. But now I understand, especially from developing countries and underdeveloping countries, people opt for UPAS LCs. There is a lack of understanding about the trade about UPAS LCs. Probably this your session will give some insights to people how effectively this can be used and how effectively the shippers' interest can be protected. So it is very, very interesting to know about that. Of course, we talk about discounting, factoring, buyer's credit, supplier's credit, a lot many external commercial borrowings, which all very useful to exporters, especially to project exporters. Now, coming back to what Ritesh said, very complex subject. Not everybody understand what he said, especially people like me understand this topic. But what was catching, what is important to me? You mentioned about the stress upon the importance of forward cover. I have seen a large number of people, maybe the large companies, large number of exporters do not bother to cover their risk, forward cover at all. Absolutely, they always say about, okay, Indian rupee is always depreciating. Why should I do it? why should do it? And I agree with them to the extent when I started my career in way back in 79, $1 was 3.30 paise. I mean, 3 rupees 30 paise, and now it is 76 point something. I have even 79 also. Okay. I agree with these people, but then you have stressed upon the importance of taking forward cover so that people will not lose any money. What you get the premium actually an extra profit to them. So I mean, I think this is a very important point, especially to the MSMEs to understand and take note of it. And large companies, as I said, I have been always saying that okay, they have a mechanism in which, of course, even large companies also I find it very difficult to operate with because there could be import payments. There could be extra payments coming at various intervals. It's very, very difficult to manage forward cover. Probably you have made certain, which I have for the first time I'm listening to this. There you have a window to cover this. Yes, this could be a good tool to put that kind of facilities so that even the large companies can protect their interests. Now,
one small thing. Sorry to interrupt, Mr. Jacob. One very small thing. Sorry to interrupt. Apologies. Mr. Jacob, one very important point about taking a forward and hedging your risk is that you are eliminating volatility. Okay.
Absolutely.
One very big thing what happens in India is, companies, let's take just about 1 month back, it was 76. And then again, a month before that, it was 74. So you take orders at 76, you do not hedge, then you realize 74, then you realize 73. So there is a direct hit to the bottom line of the company.
Absolutely.
So if you are not hedging, you're exposing yourself to that risk. And a company, there are people, there are promoters, there are employees. So if the company is not profitable, everyone feels the pain. Now, if on the other hand, if you just do a simple hedge, not only are you eliminating the volatility, you are ensuring that every time, whatever profit margin that you had envisaged, you're always getting it.
It's realized. Agree. Yeah. Another important point, what he said, okay, working capital can be of zero interest. Very interesting. Okay. I mean, I don't think anybody even thought of this, at least interest subvention. Only one point I would like to tell you about the interest subvention. In September, this issue has been taken up with the Commerce Minister in Bombay. He said, yes, it will be considered. I thought it's already been renewed. I don't know. I was not knowing that it's not done so far. Okay. Interest subvention, there is an interest subvention of LPC packing credit in INR. If there is no interest subvention available in foreign currency. Very interesting thought. So let me tell you, the session was excellent. I am sure that the participant will benefit much out of this. Thank you both. Thank both of you once again. Thanks.
Thank you, sir. Thank you for the nice words. Thank you.
It was a pleasure, sir. It was our pleasure. Thank you very much, sir.
Right. At the end, I'd like to thank you all. All the participants are distinguished speakers, our working committee members who were speakers for addressing welcome and closing remarks, and working committee members as part of our participants, Mr. Anand Iyer, our veterans, Mr. Bala Subramaniam, and other industry friends. Thank you so much. And please provide your feedback on what you would like to see as content going forward. And we would try and organize a meeting which encompasses those subjects. Thank you so much.
Thank you, everybody. Thank you.
Thank you,
everyone.
Bye. Take care. Bye.
Thank you, everyone.
Bye. How do you stop the recording?